I'm Peter White. Welcome to the Inside Network. Welcome to INDepth. I'm Peter White and my guest today is Angela Ashton from Evergreen Ratings. Angela, welcome. Let's talk about Evergreen Ratings. You're the new kid on the block. Why did you start it and what direction are you heading?
Evergreen Ratings has been, I think, a baby project for a little while now. So there was a couple of drivers. We're seeing more and more of, I guess, the illiquid or wholesale type vehicles being created by fund managers and being marketed to financial planners who are our clients in Evergreen Consultants. And I think, there's definitely a place in portfolios for those sorts of products, but the skills needed to actually analyse those products well are pretty specialist. It's a pretty complex area. So we thought the best way of solving for that was to create a group that could actually do that well and properly.
And starting during COVID, has that slowed you down or it's an irrelevancy?
It's been pretty much an irrelevancy. It may have been worse if we had tried it, say, through March or April, but given it's sort of September, October, things seem to feel, like they're back to not normal, but, certainly we're seeing a lot of product being developed and marketed now.
The financial services industry and the advice industry which you're servicing, how does it compare from today to, say, 10 years ago? Can you give us a snapshot on the changes that have taken place in your view?
Well, some of the biggest changes have obviously been the breakup of these really big dealer groups like the banks and so forth. So there's been a complete change to, independents and smaller groups really ruling the roost, which hasn't happened for a very long time. In some ways, it's back to the future. I think, 30 years ago when I started my career in financial services, it was much more like this. It was much more fragmented.
You say there's an evolution happening. What's the role of financial consultants like yourself in this industry now compared to the past?
I think compared to, when the big dealer groups really were, very big in financial planning, there's a much greater need. There's lots of groups that are much smaller and still require the same sorts of resources, inputs, ideas that, were being created by these bigger groups. So we're seeing a lot more groups demanding, quality solutions to their investment problems.
What's driving that need though? Is it the change of products available or required?
Oh, yeah, definitely partly. We're definitely in an era where the complexity and the range of products has changed a lot, say, from 30 years ago. So there's definitely part of that, but also there's just the fact that as independent groups, the ability to get the required information is just different than if you say part of a very big dealer group that has some sort of central service.
So the changing structure is favouring your business?
Oh, absolutely, yeah.
What should investment advisors be wary of or looking to happen over the next 12 months to, say, 5 years?
Oh, look, I think more of the same. More of a breakup, more independence. I think people need to really worry about compliance, best interest duties, and those sorts of things. I think it's, really now an evolution from where we are right now.
Most investment portfolios are built on the 40-60 paradigm. How does that happen now going forward when you're struggling to get CPI plus in any asset class? Is the 40-60 rule out the window or not?
Look, I think a lot of academic research has shown that 40-60 idea is definitely the place to start, regardless of the economic situation or, market environment. Ron Bird from UTS has done a lot of work on this, and the reality is it's a very good starting point, regardless of where we are. So, when you talk about CPI plus objectives, we're thinking, obviously, one of the central issues here is what is CPI? If CPI is zero, then the absolute returns required from something like that completely change. So we're not looking at a balanced fund giving us 8%, for example. And I think, time frame with respect to thinking about objectives is obviously very important as well. So if we're looking at a 5 or 10 year view, then, a lot can change in that period. So for mine, that 40-60 is a very good place to start, and then to start thinking about how you might need to change that, potentially just marginally, to get those CPI objectives over maybe a slightly shorter term.
And you say marginally changing it. Which way is the 40 going to go down and the 60 go up, or vice versa?
Oh, it depends on the economic circumstance at the time. But I'd say just at the moment, you probably would be overweighting slightly to growth assets.
Where are you seeing the greatest investment opportunities at the moment in this strange environment that we're living in terms of both interest rates and pandemics?
Oh, it's incredibly difficult at the moment. Everything is priced in many ways for perfection, and a lot of it is predicated on our very low interest rates and the fact that markets have often sort of looked through the worst of this recession. So there's a lot of good news baked in. There's a lot of risks ahead of us, the election, Brexit, and so on. So I think we're in a very uncertain environment at the moment. So to say with 100% certainty as to how things might play out over the next 12 months, I think is extraordinarily difficult. So for me, I think at the moment the cliche that there is no alternative is probably true, in that you probably have to wait to growth assets, but you have to be vigilant. I think the most important thing at the moment is to remain very diversified. So small tilts maybe a lack of duration given interest rates, the level of interest rates generally, but diversification is absolutely key. When things are unclear, you diversify.
What about, you mentioned risk, downside risk at the moment. What do you think is the area of downside risk most underappreciated in this environment that we're in?
In terms of asset classes, I think the most underappreciated area is definitely interest rates and bonds generally. All other valuations from other asset classes are built on what's happening in the bond market. And so that's the key for everything else. If something untoward were to happen there, then everything else would be affected. So I think that's the key risk.
And that's not widely appreciated enough, are you saying?
I think it's appreciated. Whether people fully understand that really is the key, I'm not fully. I think that's probably underappreciated.
We're in an era where financial advisors are becoming more important to individuals and groups. What are their most important tools going forward, do you think?
Okay, so in terms of advisors, I think there's, advisors are more than just investment. And obviously I work with the investment part of their issues. But, the role an advisor can play for a client, spans, building up a relationship that sees them through investment, estate planning, significant life events, and so on. So, there's a huge relationship that can be built and a confidence to help people get through the really difficult periods. It might be difficult investment periods like March, April, or it might be a difficult personal period. So I think, for advisors, the most important thing is to have strong relationships. That's the basis of any good advisor-client relationship.
Which is almost a hidden tool, really, isn't it?
Yeah, that's the key.
You recently joined the advisory committee of the Inside Network. Can you explain your thinking there?
Yeah, look, I think our industry is incredibly competitive, at least my part of the industry is, and there's not a lot of collaboration that goes on, or I don't see that. So I think it's great to have a forum where people can share ideas, and start to, I guess, gain the wisdom of a crowd. And I'm very lucky to have been considered, worthy to be part of it, I think. But, certainly it's a great place for us all to draw, I guess, other people's ideas and thoughts and, testing of your own ideas. So it's a great forum for that.
You mentioned collaboration. Why is it this industry hasn't been strong on collaboration?
Look, I think in terms of my part of the industry, I suspect it's because what a lot of us do is in many ways, a lot of the businesses in my part of the industry aren't very old. So, we're still growing and trying to work out where we will fit in this huge labyrinth. So, the idea of strong collaboration is something that doesn't really fit well with what a lot of us are doing. In time that will happen, I'm sure, as the industry matures and so on. But right at the moment, it doesn't feel particularly collaborative.
What should be the greatest concern to investors looking forward for, say, the next 12 months? Generating income, protecting capital, or growing capital?
It's always protecting capital. That answer never changes. So protecting capital first, and then potentially income and growth as each client needs.
Even in rampant bull markets.
Oh yeah. Yeah. Because you never know when that's going to change. Rampant bull markets don't last forever.
Can we look for a moment at the products that you'll be analysing? Can you run us through certain sorts of different typical structures that you'll be looking at, and what's happened to them in the past? Were they simply orphans that weren't analysed properly? I'd be interested to know.
Yeah, look, we're looking at quite a wide range of product. If I think about even, the sort of first lot of products that we're potentially looking at, they include solar energy projects, an ETF, property syndicates, and so on. So there's and private equity, venture capital, and so on. So there's a really wide variety of
Well, some
funds.
of those are liquid, ETFs are liquid, others maybe not so liquid. So
Yeah, absolutely. So a lot of them are not quite as liquid as, a normal managed fund, and that's one of the key differentiating features of them. So a lot of them are only open for a certain period of time. They might be open for investment for, say, 3 months, and then they close, and your funds are locked away for, 5 years or 7 years or whatever it is. So there's a lot of that type of product. It's always been around. I think what we've seen over the past 5 years or so is a huge increase in the amount of that type of product that's come to advisors in particular. And there's a couple of reasons for that. A lot of companies, and if you think, say, of private equity and venture capital and those sorts of things, a lot of those companies that are fitting into that bucket now may have at some point originally gone to capital markets, i.e. they would have gone and listed. But what we're finding is the number of companies on listed markets has actually decreased over time, over the past 20 years or so. So that's a fairly strong trend. And a lot of that is because of the huge demands that are made on companies when they list. So a lot of companies are preferring to go into private equity or whatever. So we're starting to see many more of those sorts of structures becoming available. Private debt has become available much more widely and commonly because a lot of the banks aren't lending in the same way they did, particularly to small and medium-sized enterprises and so on. So a lot of those products are now being created because of those gaps.
What's the level of awareness of private debt amongst the end investors?
Oh, probably very little. It's still a comparatively new asset class.
2 or 3 years ago you really didn't hear much about
in terms
of the average
not at all.
Investor.
Absolutely. And whereas in the US and Europe, for example, it would have been much more common. But it's a function of the way that our lending system has functioned over a long period of time. The banks in Australia have been particularly present, compared to global standards. So they have really taken the bulk of that.
They're pulling back. Yeah.
So creating the.
And you think that's
ability.
a temporary thing, the pulling back, or you think
Probably
it's a
not.
long-term thing?
Yeah, probably a structural change. Mm-hmm. So although we are seeing, some private debt now, I suspect we'll see more and more.
Now you mentioned you're looking at a solar project. That sounds interesting. Can you give that the detail of that for an example of what you're looking at?
So this group builds solar energy farms, yes, out in the country. So this effectively invests in that building and development.
And what's the time frame there, and what's the liquidity there?
It's a couple of years, so 2 to 3 years lock up, so not particularly long. But still something that doesn't really fit in, say, a normal advisor's model portfolio, if I put it that way, because it's only open for a certain period of time and then funds are locked up. So those sorts of products have been, difficult to get on, the sort of standard ratings radar.
And the low interest rate environment we're in, and looks like it's going to continue for quite a while, is that driving your business? I would imagine it is.
Low interest rates are absolutely very important. Definitely it's, helping create demand for certain types of products, particularly things like private credit, because those products tend to provide great yield. Things like private equity, venture capital, there's no yield. Or very little yield. It really is return of capital, and the timing of that is very uncertain. Property syndicates are great for yield as well, so it's definitely driving some vehicles and potentially not others.
Looking at the continuum of products that you're going to be analysing, which ones are the hardest sell for the advisors and which ones are probably the more easy sell for the advisors?
That's a really difficult question, I think. I suspect it's those that people feel more comfortable with and are more familiar with. So I would have thought property syndicates are probably comparatively easy to sell, often because, it's Australian assets, so people can feel, touch, understand them much more, and the yields can be very compelling. So I think those sorts of products tend to be easier for people to understand. I think, when we start to get to the realm of private debt, because it's something that people haven't been familiar with, then there's probably a lot more caution.
At the most esoteric extreme would be something like a solar farm or not?
Correct, yeah. So we're getting to, agricultural property is another esoteric one that, that is definitely on the horizon for people to invest in. So those sorts of things where people don't potentially understand the assets or how they behave are obviously going to be more difficult to sell.
And what's the rating mechanism you're going to use? Is it going to be 5 gold stars or 3 green trees? How are you?
Well, it's going to be 5 levels, and it's going to start at highly commended, down to commended, satisfactory, and so forth.
So it's good old-fashioned English.
Yes, very much.
You've launched a new independent fund rating service. Why do that now?
We were seeing more and more products created that were falling outside the standard rating services screens. Closed-ended products, illiquid products, quite complex products, and as a group at Evergreen Consultants, it was taking up more and more of our time. We didn't think we had the expertise to do it properly, to do it really well to the level it was supposed to be done. So Evergreen Ratings really fills that need.
And how are you going to rate them? What rating system are you using, and what does the top rating mean to me as an investor?
We're going to use a 5-level rating system that starts at highly commended and goes down to not worthy, effectively. So a highly commended product is one that would score well on all areas of our internal methodology. So internally we have screening, filtering and scoring systems that help us, consider how we should rate any particular product. And one that scored highly commended would be one that scored well across all areas. So you would expect good management, good governance, good fees, good experience and processes, and so on.
What's the main differentiating point between yourselves and other rating houses, your competitors?
I think we are really concentrating only on one area, being those illiquid and complex products. We're not interested at looking at the broad array of managed funds that are available here in Australia and can sit, quite comfortably on a model portfolio or a managed account. We're looking only at the things that are more complex, more difficult to understand, require some sort of expert knowledge.
There's been a trend for complex and wholesale products to be marketed directly to investors, the high net worth investors.
Yeah.
Where do you see that trend going?
I think it probably will continue, and partly because of the huge supply of those sorts of products that are coming to market. Obviously, wholesale investors on their own are able to make those decisions if that's what they want to do. But I think, the advice of a financial advisor and potentially a rating from somebody like us will hopefully mean that people are better informed and understand what the issues might be.
Can you give us a little bit of insight into this complex world that you're delving into? How hard to sell are these products to investors, and where is this whole area of wholesale and complex and illiquid products going?
It's becoming more and more complex. It's also becoming more and more esoteric, I think. So we're seeing things like solar farms and so on. So we're seeing, and also things like, interestingly, different parts of the VC spectrum, creating funds and launching those. So we're starting to see more and more complexity, more esoteric type products being launched. And I think that just leads to more and more confusion in people's minds. Hopefully something like our ratings product will help to, clarify some of the issues in there.
These products have traditionally been under-researched, haven't they?
Yeah, there's not been a group that has done this consistently.
What sort of characteristics should investors be looking for in these complex illiquid products in terms of both green flags and red flags?
In terms of green flags, the sorts of things that we're looking for that are effectively ticks in our process are things like strong management, good experience, strong investment processes, very good fee structures, transparent fee structures, and terms and conditions that are in line with what the product is offering. In terms of red flags, one of the very simple things that all investors should look for is the provision of services by external parties for important parts of the process. And by that I mean, for example, external custodians, external administrators, and so on. So those really simple things mean that there are another pair of eyes and essentially a pair of hands, ensuring that the process is being looked after from end to end.
Is the growth in this asset class, if we can call it that, purely due to the low interest rate environment, or is that only one of the reasons?
Oh, look, it's definitely only one of the reasons. There's definitely different structural changes occurring in the way that money is invested, money is invested in that have meant that a lot of these sorts of products have started to spring up. For example, private credit. A lot of that is the result of the banks changing the way that they lend and the sorts of groups they lend to. So they're pulling out of certain markets, which means that there are certain groups of people who require funds that aren't being banked, for want of a better word. So funds are being created to meet those needs. In terms of private equity and VC, a lot of those companies don't want to come to a listed market anymore because of the demands on governance and continuous disclosure. So potentially private equity and VC is a easier place for them to exist. So we're seeing all sorts of things happen in markets very broadly that are leading to greater supply.
Angela, thanks for talking to us today.
Okay, thank you.